What if I told you that one of the oldest mutual funds in America is heavily invested in some of the newest technology companies in the world? That sounds like a contradiction, but it's true. This fund dates all the way back to 1950. Yet today, more than half of its assets are invested in technology companies, including names like NVIDIA, Apple, Microsoft, Alphabet, Amazon, and Broadcom. So is this a hidden gem for long-term investors, or has it become too concentrated in big tech? Stay with me, because we'll examine the fund's performance, expenses, portfolio holdings, risks, and one statistic near the end that may surprise many investors. Today, we're looking at the T. Rowe Price Growth Stock Fund 1 class, ticker PRUFX. Before we get started, I want to make a quick disclosure. I currently own shares of the T. Rowe Price Growth Stock Fund that we're reviewing today. I think it's important to be transparent whenever I'm discussing an investment that I personally own. This isn't sponsored content, and I'm not being paid by T. Rowe Price or anyone else to produce this review. My goal is simply to provide an honest, balanced evaluation of the fund's performance, holdings, fees, and risks based on publicly available information. I'll discuss both what I like and what I think investors should watch carefully. As always, this video is for educational purposes only and isn't personalized investment advice. The fund's objective is straightforward: long-term capital growth. Rather than focusing on generating income through dividends, the managers seek companies they believe have strong growth potential. Although this share class began in 2015, the underlying fund itself has existed since April 11, 1950, giving it more than 7 decades of investment history. As of late June 2026, the fund's net asset value, or NAV, stood at approximately $110 per share, with more than $52 billion in assets under management. That's a substantial amount of money entrusted by investors. Let's see how that money has been invested. What does this fund actually own? The first thing that jumps out is just how concentrated this portfolio is in technology. Here's where non-diversified comes to life. The fund owns just 59 stocks, and its top 10 holdings make up 70.71% of the entire portfolio. More than 52% of the fund is invested in the technology sector. Communication services represents another 16.6%, while consumer cyclical stocks account for roughly 13%. Together, these three sectors make up over 80% of the portfolio. Looking deeper, the largest holdings include some of the biggest names in the market: NVIDIA, Apple, Microsoft, Alphabet, Broadcom, Amazon, Meta, Eli Lilly, Tesla. One fact deserves special attention. The top 10 holdings account for over 70% of the portfolio. That means the performance of just a handful of companies has an enormous influence on how this fund performs. This concentration can be a strength when these companies perform well, but it can also magnify declines when large technology stocks struggle. Has it delivered strong returns? Every investor eventually asks the same question: has this fund actually rewarded shareholders? Looking at recent annualized returns, the answer is mixed. Over the past 1 year, approximately 24.4%. 3 years, about 23.1% annually. 5 years, roughly 9.3% annually. 10 years, approximately 15.5% annually. At first glance, those numbers appear impressive. However, investing is always about comparison. Against the S&P 500, this fund actually trailed over nearly every measured time period. For example, during the past 5 years, the S&P 500 averaged over 14% annually, while this fund returned roughly 9%. The 10-year comparison tells a similar story. The S&P 500 slightly outperformed this actively managed fund. Even compared with the overall Morningstar large growth category, the fund ranked around the middle of its peer group. That doesn't mean it's a poor investment. It simply means investors should understand that higher management costs don't automatically translate into higher returns. What about fees? One of the easiest mistakes investors make is ignoring expenses. This fund carries an expense ratio of 0.52%. That means approximately $5.20 annually for every $1,000 invested. Is that expensive? Not compared to many actively managed mutual funds, but compared to low-cost index funds charging only a few hundredths of 1%, it is noticeably higher. Fees may appear small, but because they're deducted every year, they quietly reduce long-term compounding. Even 0.5% annually can become thousands of dollars over several decades. That's why experienced investors always compare expenses before investing. Understanding the risks. Every investment involves risk. The fund itself points out several important ones. Because it focuses on growth stocks, returns can be more volatile than the broader market. Growth companies often trade at higher valuations because investors expect rapid future earnings growth. If those expectations aren't met, stock prices can fall quickly. Another consideration is diversification. Morningstar identifies this as a large growth fund with a strong emphasis on U.S. companies. Approximately 96% of the portfolio is invested in domestic stocks, while only a small percentage is invested internationally. That means investors seeking global diversification would likely need additional funds in their portfolio. The fund also holds very little cash or fixed income. Its success depends almost entirely on stock market performance. The portfolio manager's challenge. One interesting detail is that the current lead manager assumed responsibility in 2025. That's important because active investing depends heavily on management decisions. Unlike an index fund that simply follows the market, an actively managed fund requires continual judgment. Managers must decide which companies deserve larger positions, which stocks should be sold, which new opportunities are worth pursuing. Those decisions determine whether the fund can outperform its benchmark over time. History shows that consistently beating the market is extraordinarily difficult, even for talented professional managers. The bigger investing lesson, perhaps the most valuable lesson from this fund, isn't about T. Rowe Price at all. It's about investing itself. Many investors assume that active management automatically produces better returns. Sometimes it does. Sometimes it doesn't. The data remind us that even a well-managed, highly respected fund with billions of dollars under management can struggle to consistently outperform a simple index. That doesn't mean active funds should be avoided. Instead, investors should evaluate each one carefully, ask questions, compare expenses, study long-term performance, understand what you actually own. The goal isn't to find the most exciting investment. The goal is finding investments that help you steadily build wealth over decades. Conclusion. So, what's the final verdict? The T. Rowe Price Growth Stock Fund offers a long operating history dating back to 1950, exposure to many of today's leading growth companies, reasonable but not ultra-low expenses, strong historical returns, although recent performance has generally lagged the S&P 500 and many large growth peers. A concentrated portfolio that could outperform during technology-driven markets, but may experience greater volatility during downturns. For investors seeking growth exposure, it's certainly worth researching further. But as always, no single mutual fund should be purchased without considering how it fits into your overall investment strategy and risk tolerance. If you own this fund or have owned it in the past, I'd love to hear about your experience. And here's my question for you. Have you ever opened a statement and found a fund you never actually chose? Something a plan put you in years ago. What was it, and what did you do about it? Tell me the story in the comments. And drop the ticker of the stock or fund you want under the microscope next. The most requested one gets the next video.